The FHFA decision to allow Vantage Score is impacting FICO, and investors are asking me if I think FICO stock is a buy. I last visited this company in March where I told investors it was too expensive, and now I'll revisit the company, look at the latest results, and update that buy or sell recommendation. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So FICO has been one of those businesses, Fair Isaac Corporation has been one of those businesses I viewed as being close to a monopoly. There are very few competitors, even though this latest result could increase the amount of potential competition. It still represents a very small fraction of this market right now that FICO dominates. And overall, FICO's revenue per credit report that they charge to lenders is such a small percentage of the overall transaction and such an important part of the overall transaction that its business has boomed over the previous decade, even though the overall market has not increased by all that much in that time. FICO's revenue has increased from $800 million in 2015 to $1.9 billion in the most recent trailing 12-month period. That's good for a compounded annual growth rate of 9.2%. Another thing I've really liked about FICO's business is it hasn't got distracted going into other business categories and using the cash flow it's generated from its lucrative business opportunity to invest in less lucrative opportunities. That's allowed the business to continue improving and expanding margins. Its operating profit margin has increased from 18.6% in 2015 all the way up to 46% in the most recent trailing 12-month period. An operating profit margin of 46% is near the best of any company I'm following. Remember, the highest operating profit margin of any company I follow is Visa and NVIDIA. NVIDIA has been going back and forth with Visa, but for the previous decade, if you average the operating profit margin, Visa has been the best in the selection of the companies that I follow at around 65-67%. So at 46%, FICO is very near that top of the rankings of those businesses. So it's an absolutely excellent, lucrative business model. Close to 10% compounded annual revenue growth combined with an operating margin of 46% is a powerful combination, and you can understand why many investors have been attracted to FICO stock in recent years. Similarly, the returns on invested capital are exceptional. 46.6% ROIC. That's up more than 4x from 2016, where it was 11.8%. So all of the critically important financial performance metrics are really strong for FICO. And the stock price had reflected that. When I visited this company around March, the valuation was very expensive, and I told investors that it was too rich, too expensive. It's a great business. I would love to own this business, but it was way too expensive, and it's been really expensive. It's no secret to the stock market. Seems like everybody and their cousin knows how good of a business FICO is. And now with the recent decision from the FHFA with the Vantage Score, that provided a little bit of an opening because it introduced some risk to its near monopoly in this market. But I don't think the valuation retraced enough according to that development. And here's what I mean. So FICO had been trading at a forward price to earnings above 50 for a long time, over a year and a half or so. And the valuation dipped for a moment to below 40, but it's now trading at a forward PE of over 45, which if I was just looking at the forward PE and I was looking at the performance, revenue growth, operating margins, and ROIC, then a forward PE of 45 looks undervalued actually. Because the business is just performing so excellently across a myriad of financial metrics. But when I also account for valuation using my discounted cash flow model is where the valuation starts to look expensive, because the intrinsic value or the fair value, and I updated this today, The fair value for the stock I calculated is $1,054. Current market price is $1,543. So it looks overvalued significantly, even after applying a margin of safety here. And I'm forecasting pretty optimistic figures for Fair Isaac Corporation. I'm forecasting a longer term growth rate of 5%, which I don't usually do. 3% is my typical longer term growth rate expected for companies. 5% I apply to some companies where I feel their growth rates are connected nominally to GDP and not inflation adjusted. And then the discount rate, the weighted average cost of capital I'm calculating here is 11.23%. You could argue it should be lower. The beta is 1.35, and you can argue that this beta deserves an adjustment lower instead of just using the market beta that I've evaluated historically. You can argue that it should be lower. And then I'm applying a target capital structure of 15% debt and 85% equity. Now, you can argue the debt should be a higher target capital structure. The equity should be lower since they generate such consistent free cash flow. This is the type of business that can afford to have a larger percentage of its capital structure via debt because of that stable cash flow. They can afford to service that. And you can see the cost of debt I applied here is just 5.75%, and the cost of equity at 12.2%. So if they shifted the capital structure more towards debt, that would reduce the weighted average cost of capital, which of course is the figure I'm using as the denominator to discount these cash flows, which would then warrant a higher valuation for Fair Isaac Corporation stock. But those would require many more adjustments, right? Adjustments in favor of the business to make it more attractive for investors. Without those adjustments, this is the valuation I'm arriving at. $1,054 compared to the current market price of $1,539. And I haven't accounted for the risks with this new development with the Vantage score because I haven't seen enough in the marketplace where dollars and capital are shifting towards there. Maybe you can argue that the introduction of a potential competitor could lower the company's pricing power, and so it can't generate the kind of growth that it generated in the previous decade. That's certainly a risk as well. So all of these factors contributing to my feeling that this business at the current prices is not so attractive, even though it's an absolutely excellent business. So I mentioned I've had this stock rated as a hold, and I last visited around March. Today I updated that hold rating for Fair Isaac Corporation. Love the business, would love to get it at a lower valuation. I don't expect to be able to because so many investors love this company. There's no secret about how lucrative its business is, how strong its pricing power has been, and the relative competitive advantages it boasts against anyone else who would aim to take any kind of market share in this industry. I would just hope to get this at a lower price. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.